I think that yesterday what we were talking about was this tug-of-war behind a lot of the stimulus released by the central banks, which is a positive for markets, and the slowdown that we are seeing in terms of growth and global growth. And really we're seeing that tug-of-war playing out, and today it was those growth concerns which dominated. I think the most incredible thing about the market today was that we saw just $3 billion worth of turnover. If we compared that to the average over the last 30 days, that's about 30% below that average of $4.2 billion. And the last 30 days by no means has been great in terms of value traded through the market. It's just that today has been extraordinarily low. If we have a look at those stocks reaching 52-week highs and 52-week lows, I think that tells a story in itself. We have a look at the 52-week highs. We've seen Premier Investments hitting that high. We've seen Australian Pharmaceuticals hitting a high, as well as Collection House. Now, if we have a look at Premier, this is being driven by its earnings result, its positive outlook for growth, and the market's really gotten behind a company like Premier, so that's been a good news story. Australian Pharmaceuticals, it's in a defensive space, and still there is that defensive tilt to a lot of portfolios in the market. And Collection House, this is a business which does well usually when the Australian economy is deteriorating. We have a look at the 52-week lows. We've seen 52-week lows today by Whitehaven Coal as well as Fleetwood. Now, these are both areas of the market which are exposed to the coal sector, to that mining story, and we're still seeing a fair bit of weakness there. In fact, the materials space was the weakest area on the market today, and that does follow a warning out by Caterpillar, and it follows hot on the heels of the FedEx warning that we saw last week. We also saw IMF comments, Christine Lagarde coming out to try to encourage global leaders to take some more stimulus measures, or to help try and help that global growth story, which does seem to be slowing down. So unfortunately, a bit of a disappointing day on the market in terms of volumes. The market lost. We didn't see a huge movement, down by 0.3%, but really it felt like Christmas, like everyone was on holidays, and I guess it is the holidays, school holidays.
That against what has been quite an appetite in the retail land for a lot of sort of corporate bond offers and so forth, and we've got a plethora of the moment. Do you expect to be able to have both at the moment? I mean, you look at some yields, treasuries, for example, still very, very low, but you have equities rising. I mean, could you have a similar scenario here where people are still very keen on those corporate bond, those retail offers, but also looking to start piling into equities maybe early next year?
Well, we have seen the equity markets quiet in 2012, but one area, as you mentioned, James, which has been on fire is the corporate bond space as well as the fixed interest space. We've seen Pearl 6, that's been pulled back quite substantially, and we've seen that oversubscribed. They were aiming to raise $750 million. Instead, we saw $1.5 billion being raised. That's double the amount that they really set out to do. And then we've seen this Bendigo issue as well, looking to raise $125 million. This is a convertible preference issue. And this is quite unique in that it's the record margin for a financial institution in the corporate bond market. So it is quite an attractive yield, 5 to 5.5% above the 90-day bank bill swap rate. So that takes the yield up to about 8.5% on the lower end. We've also seen Suncorp Metway coming out with its own convertible bond issue, looking at $250 million there. And with Bendigo and Suncorp Metway, they're looking to do these issues to replace previous debt issues that they've done in the past. Of course, when we have a look at these financial institutions and weighing up the attractiveness of these issues, it's not just all about the margin, but it's all about the bad debts as well, the funding that that particular financial institution has, as well as the capital adequacy levels. But it's not just the retail corporate bond market which is on fire at the moment. What we have seen is a lot of Australian corporates going into the US market for cheaper funding, and also that high Australian dollar helping. Today we heard from Newcrest Mining looking at $1 billion to help replace some of its debt, and we've also seen Westfield looking at a $500 million issue over in the US, and it goes the other way as well. We know that there's a strong demand for Australian government debt over here, and with that demand, we've seen some corporates, some overseas corporates, looking to issue debt or kangaroo bonds here in Australia. And in the last couple of weeks, we've seen Shinhwa Bank from South Korea, we've seen MetLife, which is a US insurer, and we've also seen Korea Gas issuing kangaroo bonds, so issuing debt in Australia. So I guess the fixed interest market very much on fire. In terms of the equity market, pretty quiet, but if we have a look at certain areas of the market, I think they're a lot more attractive than others. And I guess some of the areas which investors are a little bit still cautious about is the materials and the industrial sector, given the outlook for global growth. But areas which are looking pretty attractive is the gold sector. Regis Resources is one that we're looking at in that area. And the banks, with interest rates dropping, funding pressures easing, the banks are looking pretty good, and we've seen the auction clearance rates this weekend, the highest that we've seen in 2 years.